Okay, so one last class of assets, other long-term assets. So again, this is another miscellaneous. We have two miscellaneous categories, one that's current, one that's long-term. They're related items that are put in these. We put the long-term portion of prepaid expenses. So contracts that extended beyond a year. In that case, if we had, say, at 12/31/23 had a 2-year contract, then we would split it on this balance sheet date. If it had 2 years remain, I'm sorry, it's not up there. If we had 2 years remaining at this date, then the portion of the contract that spans to 12/31/24, right? That very next year, this is other current assets. And the portion, the price that would cover me beyond that, all the way up to 12/31/25, that would be other long-term asset. So even if this is $100,000, 50 a year, 50 would be reported as other current, 50 would be reported as other long-term, right? Just based on when we're going to use the item. Once we get to 12/31/24, this portion of the contract then becomes current because we're going to use it in the next year. So it's a rolling window of assessing when we're going to use items. Property, plant, and equipment that has been retired, because remember, PP&E, the definition of PP&E requires that currently used. If it's not currently used and it's not held for sale, then it's an other long-term asset. We have to kick it out of PP&E if we're not using it, only when it's held for sale, because remember that held for sale designation only works when we have the intent and ability to sell it within a year. When it's being held for sale and classified as such, it becomes an other current asset. So two things that are related to items that are in other current assets, but don't meet those definitions, so they come down here to other long-term assets. In general, in intermediate, we just need to keep our wits about us in terms of understanding what the asset is being used for, because the purpose of the asset is where we want to classify it, not just the name. So land that's being used as a factory building, that's PP&E. But as we talked about, land that's purchased for speculation on a potential increase in value, that's not being used as PP&E. Its underlying purpose to the company is an investment, and we classify it as such. And of course, we need to think about whether or not it's actually being used. Those little caveats are starting to become important and are part of the new material we need to consider in intermediate. So with that, let's jump into liabilities and equity. As I mentioned in the announcement, a lot more simplified here. We only have two designations of liabilities, current and long-term. Current payables. This is a huge piece of our current liabilities. Accounts payable. Remember, accounts payable, these are purchases on credit. They are almost always short-term, typically for inventory, supplies, small items. No interest rate on accounts payable. We're going to compare those to notes payable in just a second. Wages payable, what we owe our employees, dividends payable, taxes payable, and I would also add interest payable. That's one that just isn't on this list. That's pretty frequent. Interest payments on loans almost always arise within a year. So any of these payable accounts are always current. Unearned revenue, right? Deferred revenue. We've talked about this, prepayments for delivery of services or products in the future. This one can be current or long-term, depending when we expect to deliver on our earnings obligation. So if we are going to deliver an item within a year or provide a service within a year, then that's going to be a current liability. But if our contract with the customer has us delivering services beyond the next year, then Some of that will be current. The amount that we're going to actually provide in the next year would be current, and then the remainder is long-term. The third item is what we call short-term maturities of long-term debt. This could also just be called current maturities. What is going on here is, again, this idea of items being paid out on a rolling basis. So I have an example. Let's say that we spent some money. We borrowed money, $1 million of debt, and we're paying it off in installments. We're going to pay it off at $100,000 per year. And if that first payment is coming due on 1/1 of 20x2, right? We borrowed it at 1/1 20x1. Our first payment of $100,000 is going to be due January 1st of 20x2. Then let's look at the different balance sheet dates. Well, at the end of that year, when we borrowed it, we haven't made a payment yet because the first payment's going to be due the day after December 31st. In that case, 100,000 is going to be current and 900,000 becomes long-term for that period. Now, when we get to the next year, right, we've now paid off that current, that 100's gone, it's been paid. But now we have another 100,000 from this piece coming current because we're going to have to make another payment on 1/1x3. So that's 100,000. And now there's only 800,000 remaining. And that would cycle through again. We make this payment on 1/1x3, but at the end of x3, we will have another payment at the first of the year, x4, 100,000, but only now 700,000 left long-term. And it would just keep cycling like that, right? Reclassifying long-term liabilities to current as payments are coming due. The final item that can be short-term is a note payable. Some notes are payable or will become payable in less than a year. And again, a very big distinction between notes payable and accounts payable. Don't get the two confused. Notes tend to have those interest rates attached to them. Accounts do not. They have specific enforceable payment dates, whereas accounts do not. And this is true for both notes payable and notes receivable. Right? Those items are different. They're distinct from accounts payable and accounts receivable. And you really need to get that down. And it's really important that you use the correct term, or else things will be off. For long-term liabilities, we have a couple of items here. The biggest one is bonds payable, and then long-term notes payable. So both of these are lending, right? Both of these are where we borrow from lenders in order to receive some money in order to finance our operations. Both of them are long-term. We're going to be paying interest on both over many years. Defaulting on any of them can lead to repercussions for the company that borrowed. So make sure that you understand the difference, which is long-term notes are usually loans from banks or financial institutions, whereas bonds result from the company selling bonds to investors on a bond market. So just as equity trades on stock markets, there are markets where companies can issue they can issue bonds, sell bonds to people who want to buy them. Then whoever buys them gets the interest payments from the company who is borrowing. They then also will ultimately receive the amount of money that is agreed to, the principal of the amount that they invested in. So bonds payable, as we saw before, are the counterparty transaction, the liability that's being sold to an investor who records it as an investment in a debt security. The big difference is we sell bonds on markets to multiple people, thousands of people. tens of thousands of people. Long-term notes, we're borrowing from a specific institution, perhaps a few banks or a few financial institutions, but it's not a market transaction. Also to remember, with either of these accounts, they come with discounts and premium accounts. So discounts are contra liabilities and premiums are adjunct liabilities, which means that if we have a discount on a bond, then the accounting rules are debits would increase this and credits would decrease it because we have a contra liability. The liability it's attached to, of course, is the bond account. Whereas with a premium, and a premium is a very different type. This is an adjunct liability. So it's the opposite of a contra. It's attached to bonds. It's increased with credits and decreased with debits. You won't have both on a single bond, but you'll have one or the other. And what these do is they adjust the amount that we record in the bond to the present value of cash flows. So we add the amount of the premium or subtract the amount of the discount from the principal of the bond. That's the face value of the bond that we're talking about. And that gives me the present value of cash flows. We'll talk more about these when we work through problems. Students tend to have a little bit of an issue understanding the present value idea. Other items we can see as long-term liabilities would be pension liabilities for companies that still have defined benefit plans. Those are becoming somewhat archaic, sort of dinosaurs. Usually now there's 401ks for which companies do not have to record a pension liability, but some of the old companies, some of the big old companies on the Fortune 500 still have their defined benefit programs. Contingent liabilities are another item that we can see on long-term liabilities, which is when we record a liability because a product recall is probable, a lawsuit might be probable a lawsuit will be settled against our company. And another instance of a warranty liability that's always recorded, a contingency that's always recorded are warranty liabilities. When a company offers guaranteed manufacturer's warranties, this is something that we always accrue as a payable.